Well, it's a pleasure to be with you today to talk about the fragile global economy and personal finances. I'm Professor John Anderson. I'm at the University of Nebraska in Lincoln in the United States. So it's my pleasure to be with you and to talk about the current situation we're confronting in our global economy. Let me start by identifying some global hotspots which are contributing to the fragility of our global economy. I've got three hotspots identified here in the world that have economic and strategic importance and some nuclear proliferation implications, which are contributing to our fragility currently. And these hotspots include, first of all, North Korea. Secondly, China with its affiliations as well with Hong Kong and Taiwan. And then, of course, Russia and Ukraine, which is on the forefront of our thinking these days with the war going on there. So I want to consider how the fundamental ideas or the worldviews on which those economic systems are based have got important consequences. So I want to talk about the fact that ideas have consequences, and our ideas about political and economic systems have implications for the well-being of people in our countries and their economic well-being as well as their broader well-being. So the question here is whether the choice of a political and economic system matters. And let me simply appeal to an obvious example. The natural experiment we have on the Korean Peninsula with two distinctly different economic and political regimes. This is as close as we can come to running a controlled experiment in economics. Take a peninsula like this with similar topographic features, similar climate, similar natural resources and other factors. A population that is fairly homogeneous as well throughout the peninsula. Draw a horizontal line across the peninsula and run an experiment with two different systems being operated in the north and the south. In the north, you've got a command and control economy that's been in place since the end of the Korean War. In the south, you've got a much more market-oriented economy. And as this satellite image reveals, there is a dramatic difference in the economic conditions in the North and the South. So the outcomes clearly differ, confirming that economic and political ideas that are implemented have consequences. In another context, let me appeal to China in particular here. Ideas have consequences there as well, as we've seen in recent history. So China has implemented alternative approaches in recent years, essentially since 1978 with Deng Xiaoping. And they've implemented what they call socialism with Chinese characteristics. So a prime example of what they've done is the village of Shenzhen, which was just a small fishing village near Hong Kong 30 years ago, until Shenzhen was made their first special economic zone. And within that zone, they allowed market principles to apply rather than the usual command and control principles in the rest of mainland China. And as a result, today, Shenzhen is a modern city of more than 17 million people, and they make products that are sold around the world. So if you're currently holding an iPhone or watching this on an iPad, those products are made in Shenzhen. Per capita income has nearly quadrupled over the last 15 years. And so if you ask once again whether ideas have consequences, they clearly do. And in this case, the idea of allowing some market principles to operate in special economic zones has had the consequence of fast economic growth. And so these special economic zones have proliferated across the mainland of China, and the Chinese economy has performed amazingly in the last 20 or 30 years as a result. Due to the economic strength that's been developed with China, the influence of that country now pervades the entire region, and it creates instability in some ways. The political influence that the mainland China has had the last several years in Hong Kong has been evident, and we're currently worried about the situation with respect to Taiwan and the independence of Taiwan, as mainland China is increasingly moving toward influencing more directly affairs in Taiwan. There have been territorial conflicts with Vietnam and Japan in the South China Sea, as this graphic illustrates. And of course, China's been active all around the world in pursuing natural resources, including, for example, in Mongolia, looking for natural resources of many types, including oil and coal and precious metals of various types. So the Chinese influence is pervasive, not only in the South China Sea, but more generally in Central Asia and throughout Africa and South America as well. Currently, with respect to the war going on with Russia invading Ukraine, we've also got the worrisome development that China is supporting Russia's invasion, and that raises concerns that maybe China may be emboldened to do something similar with respect to Taiwan, as I've indicated. So let's talk more specifically about the Russian invasion of Ukraine. If we're worried about the fragility of the global economy, this is certainly top of mind. So just last month, late in February, Russia invaded the Donbas region in eastern Ukraine, illustrated in this map. And the breakaway regions of Luhansk and Donetsk were recognized by Russia as independent. And the invasion has gone further, of course. Russian troops are now attempting to encircle the capital city of Kiev, and they've been bombing Kharkiv and other major cities. And they're not only marching in from the east, but also from the north. And there's an effort in the south as well to control ports on the Black Sea. So these are worrisome events and are contributing to making our global economy even more fragile. While I've got this map here, let me point out with my cursor this little breakaway region on the east side of Moldova, or the western boundary of Ukraine. I'm going to come back and talk about this breakaway region called Transnistria in a little bit. So as a result of these events, there are really three global economic concerns currently that are causing us to think about the fragility of the world economy. First of all, inflation. Secondly, reduced economic growth. And thirdly, disruption to financial markets. So let me talk about each of them briefly. So inflation is a major global concern, and this was the case before the war in Ukraine, but the war is exacerbating our concerns about inflation. Global expansionary monetary and fiscal policy during the pandemic of the last 2 years is contributing to inflationary pressures, of course, with very expansive monetary policy and fiscal policy on the part of many countries around the world, feeding into inflation. But then also contributing to inflation is what we've experienced with supply chain disruptions. And so we've got inflation coming from several sources. This graphic shows you for the US, Europe, other advanced economies, China, and other emerging markets and developing economies, the changes in inflation up through or since December 2020. And so you'll see for the US, the major contributor to inflation is the blue portion of the vertical bar, which is due to energy prices rising. Not so much related to food, which is the golden portion of the bar. You'll notice for Europe, of course, the major contributor to inflation is energy prices. Europe being much more heavily reliant on Russian oil and natural gas, and where prices have been rising recently, this is getting worse. Then you'll see for other advanced economies, the inflationary pressure is not quite so heavy, but again, it's dominated by energy price increases. And even in China, you've got inflationary pressures being fed by energy prices rising primarily. For other emerging markets and developing economies, the far right-hand bar in the chart, you'll see you've not only got energy price pressures, but you've got in the red portion of the bar, you've got depreciation of domestic currencies, foreign exchange pressures as well. So we've got inflationary pressures that pre-existed the war in Ukraine, but are going to be exacerbated by it. And so there's a strong degree of concern about global inflation currently. That kind of concern has led to a recent joint statement by the IMF and the World Bank officials, David Malpass at the World Bank and Kristalina Georgieva, of the IMF recently came out with this joint statement that commodity prices are being driven higher and risk further fueling inflation, which hits the poor the hardest. Disruptions in financial markets will continue to worsen should the conflict persist. And this, of course, is the conflict in Ukraine they were talking about. The sanctions announced over the last few days will also have a significant economic impact. So I'll talk more about these sanctions momentarily, but this statement captures nicely our concern about global inflation and the fragility for the global economy that's involved. The second way in which we're concerned about the fragility of the global economy is our expectation of reduced economic growth. So what I've got here are the IMF projections, the International Monetary Fund projections. They were already indicating slower growth this year in 2022 and slowed growth in 2023 globally prior to the war in Ukraine. And so these are upper bound estimates in my mind and likely to be revised downward depending on how long the war goes on and how high energy prices spike and other factors. So if you look at the advanced economies row of this table, you'll see that they were projecting a 3.9% increase in GDP, gross domestic product, for the advanced economies this year, and a lower rate of growth next year, 2.6%. The US was slightly better this year at 4%, according to their prediction, but the same next year, 2.6%. The euro area, similarly, 3.9% this year, 2.5% next year. And you can see the individual major economies within the euro area listed there as well: Germany, France, Italy, Spain. And so you see that the predictions prior to the war were that we would have slowing economic growth in any case, coming out of very expansionary policies in 2021, both expansionary fiscal and monetary policies that were stimulating growth across advanced economies. The expectation was that those rates of growth would be slowing down. The next slide shows you for emerging markets and developing economies what their predictions were. So you may be most interested in emerging and developing Europe, that row, where coming out of last year's 6.5% GDP increase, they were forecasting a 3.5% growth this year, which is almost half of last year's rate of growth, and even less next year, 2.9%. So if you look at the table, you'll see they're still forecasting relatively strong growth in India, lesser pace of growth in China, and some notable weakness in places like Brazil. But nonetheless, the main point is that the rates of growth were anticipated to be falling this year and next year in any case. And the fragility of our global economy, exacerbated by the war going on in Ukraine, is likely to reduce these numbers further. The third aspect of our global economy and its fragility has to do with disruption to financial markets. So the Russian economy is taking a major hit due to the sanctions that have been implemented and the collapse of the ruble in particular. They're subject to limitations of the SWIFT payment system. This is the system that's used by banks worldwide in order to transfer funds across international borders. And those limitations are going to affect all of Russia's trading partners, including those in Western Europe that formerly used the SWIFT system to pay for natural resources that they were importing from Russia. So all the economies that are linked with Russia through international trade are going to be feeling the impacts, especially countries where the currency is highly correlated with the Russian ruble, which has taken a real serious hit recently. And stock markets worldwide have retreated due to the war uncertainties as well. So with regard to the ruble in particular, this slide shows you how the ruble has collapsed in value just recently. I went and looked the numbers up, and from February 16th, when there were 0.013 rubles per US dollar, that fell essentially in half to 0.007 rubles per dollar just 3 weeks later on March 7th. So we're talking about going from about 70 rubles per dollar to 140 in effect with those numbers if you invert them. So as a result, I would expect Russia may soon default on its debt payments, and this is reminiscent of 1998 when the ruble collapsed. And I happened to be living and working in Moldova at the time. And of course, the Moldovan leu, the currency in Moldova, collapsed along with the ruble because of the high correlation between the two economies at the time. So the question arises as to how well can Russia withstand the sanctions that have been implemented by the West? So I've got a couple charts here to look at that question. So this chart shows you the value of Russian exports by major categories. And you can see here the red part of the chart is mineral products, including oil, natural gas, and coal. So the Russian economy is primarily an extraction economy, extracting natural resources. And it exports those natural resources not only to Western Europe, but to other parts of the world as well. In economics, we have a theory we call the resource curse for economies that are highly dependent on extractive industries. And as a result of that, if it's easy to simply extract resources to fuel your economy, then there's often a lack of development in other sectors of the economy. We see this most notably in the Middle East, of course, where oil is produced, but it's also characteristic of other economies that are highly reliant on extractive industries, where you simply extract the natural resources and export them. You've got less incentive to develop manufacturing and services and other aspects of the economy. So what's important to notice is that the Russian economy is highly dependent on extraction of natural resources and exporting those. The second chart here shows you the extent to which Russia's exports go to various parts of the world, and compares their exports in the upper half of the chart with their imports in the bottom half of the chart. So you'll notice, first of all, that generally speaking, Russia's exports are greater than its imports. So it's reliant on exporting mostly natural resources out of the country. And if you look at the far right-hand bar, you'll see that much of the natural resources that they extract in the form of oil and natural gas go to the European Union, and secondarily to China. The US slice of that is relatively small. In checking the data on oil exports to both the EU and the US, I find that about 3% of the oil used in the United States is coming from Russia at this point. But in the European Union, that's more like 30% of the oil. And so the EU is much more reliant on Russian resources than the US. But what's notable here is that Russia, while it may be losing some of its markets for exports in Western Europe, it's looking eastward. And the state-owned Rosneft oil company in Russia recently signed an $80 billion deal over 10 years to supply the China National Petroleum Corporation with 100 million metric tons of oil. And so Russia, to the extent that it may be losing some of its Western markets for oil, maybe substituting selling oil to China. I don't think they can completely make up for the loss of Western markets, but nonetheless, they're moving to sell their oil to the east rather than the west. The other thing that is notable about Russia and its preparations for this war is that they've, for the last several years, they've been building their international reserves, which might be expected to insulate them to some extent from the impact of carrying out a war and potential sanctions. But if you look at this chart, it shows you that since about 2015, their international reserves have grown substantially. In the form of foreign exchange reserves primarily, but secondarily with regard to gold. And while you might expect that this would insulate them to some extent from the consequences of sanctions as a result of the war, I would point out that the sanctions with regard to the Russian central bank in particular mean that the foreign exchange reserves are essentially unusable. They can't really use them for international payments because of the sanctions. And then secondarily, gold, while it's an important element of their reserves, the gold is not very liquid. And so I think here's where the sanctions have an important role to play in essentially taking away this set of resources, in particular the foreign exchange reserves that might have been expected to help Russia survive sanctions during the wartime. So let's move on to talk about how I think we've seen this movie before. And here I'm appealing to my experience having worked in the former Soviet Union throughout the 1990s and the early 2000s. So I want to encourage you to think about the parallels between the current situation in Ukraine and what we saw in 2014 in Crimea and the earlier precursors, what happened in Moldova in the early 1990s and in Georgia in 2008. So again, let me point out the Transnistrian breakaway region in eastern Moldova. And I've got an arrow here that shows you the thin little strip between the Dniester River and the western border of Ukraine, which is a breakaway region of Moldova. In much the same way we've seen the breakaway regions in Georgia recognized by Russia and in Crimea, and now in eastern Ukraine. The parallels are very similar here. So what happened in Moldova in the 1990s was as Moldova gained independence when the Soviet Union collapsed, Moldova started to look westward and want to affiliate more closely with Romania and Western Europe. But Moldova had a mixed population as a result of the Russification of the population. This goes back to the time of Hitler and Stalin and the way they carved up that part of the world in 1939 with the Molotov-Ribbentrop Pact. Moldova had been ethnically Romanian, and yet with Russification, a Russian population was developed in the country, especially in the east, although the western part of Moldova was more Romanian ethnically. And so with independence and Moldova wanting to move westward, Russia wanted to keep it within its orbit in some sense, and so stirred up problems in the east, in the Russian-speaking Russian ethnic enclave in the eastern part of Moldova. And eventually there was a civil war that was fought to a stalemate, and the breakaway region of Transnistria across the Dniester River to the east is still an unrecognized breakaway region ruled by a little czar, Malinki Czar. And in my mind, it's an ultimate free trade zone. Through that breakaway region, all kinds of things are traded, including weaponry that was left over from the Soviet era in the early years. But then drugs were and still are trafficked through that breakaway region, and it's also a location for human trafficking. Women are trafficked out of Ukraine and Moldova into Western Europe. So it's the ultimate in a free trade zone. And what happens in a breakaway region like that is pretty typical. They need to pay for their debts. They don't have a well-established system of public finance or a central bank, and so they monetize their debt. They effectively print money. And I love this example that I picked up while living in Moldova. This is the Transnistrian coupon. And it's the form of currency that they printed to use in the breakaway region of Transnistria. You'll see on the backside of the Transnistrian coupon that it was labeled as 1 ruble, 1 ruble, it says on the back. But if you look at the front, you'll see that since 1994, when the coupon was originally printed, it was stamped in 1996. And what they did was they added 4 zeros to the coupon. So it became a 10,000 ruble coupon. If you can read the Russian, it says 10,000 there as well. And so this is typical of what happens in these breakaway regions. They end up with hyperinflation. And if you know anything about the quantity theory of money in economics, you know the impact of adding 4 zeros to your currency is a guaranteed way to have hyperinflation. So it's just the classic example of what happens when you monetize your debt, and the consequence is hyperinflation. Well, with that overview of the fragility of our global economy and some of the issues related to it, let me now turn to the question of personal finances. How does a graduate student in particular think about navigating in a fragile global economy with respect to personal finances? Let me suggest what grad students need to adapt and to thrive in this kind of environment is a threefold set of skills. First of all, some solid core values. Secondly, a comprehensive toolkit. And thirdly, resilience. Let me talk about each of them briefly. So core values are essential for life success. Personal integrity requires a set of strong ethical standards or core values. And that requires an absolute standard, some kind of a North Star or a fixed point around which everything in life revolves. So unless you've got a fixed point like that to anchor you in life, you're going to end up being adrift. I've done a lot of research on corruption and bribery especially in transition economies, those that are transitioning from being centrally planned to more market-oriented economies. And I've seen the effects of bribery and corruption as it erodes trust in government, and as it erodes people's willingness to pay taxes to support the government. So the research I've done confirms that bribery and corruption, which are born out of weak ethical standards and not having a fixed point of reference for establishing your ethics, your personal ethics, can be corrosive. In the case of Russia, this has been described as the grabbing hand, as distinct from what we sometimes call the invisible hand of the marketplace, Adam Smith's invisible hand. By grabbing hand, the researchers have meant to characterize a kind of rent seeking that goes on, simply looking to appropriate economic wealth that's been created by others. Secondly, I think grad students need to have a comprehensive toolkit. So success in a fragile and changing economy require a comprehensive toolkit of skills and experiences. So I think, first of all, you need analytic tools, right? If you're in the field of economics, as I am, you need to know your economic theory. You need to develop empirical skills for doing statistical analysis, and you need to be able to apply both the theory and the empirical skills to current situations. Now, if you're in some other discipline, I think these same principles apply, that it's important to have a whole array of tools in your toolkit in order to make yourself useful in an uncertain economic situation. You need to develop your human capital skills, and you do that by getting your education, by taking advantage of internships, by job training and other means. And in my experience, it's your analytic ability that's likely to get you your first job. It may not be directly related to your major, but analytics ability prepares you for a wide array of possibilities in the marketplace, whether it's in industry or in government or in academia. Analytic skills are likely to get you your first job. And then your broader academic training can help you adapt and progress in your career. And so it's often the case, I tell my students in economics, that you'll get your first job because you're a good statistician, but you'll eventually become the CEO of the corporation because of your broad training in economics. Or you become a policy advisor, or in some other way, perhaps in academia, become a noted researcher. The third thing I think you need is resilience, especially in a fragile global environment. Resilience enables you to adapt to changing circumstances. You develop the ability to adapt through varied experiences and a mindset that sees opportunities, not only obstacles. So as you face challenges in your economic setting, you may view those as obstacles, but if you can flip those over and see them as opportunities, you'll develop resilience and you'll be able to navigate through the uncertainties of the economic situation in which you find yourself. Positive psychology and developing psychological capital, what my colleagues in the management field called PsyCap, has been shown to be highly effective, not only for individuals, but for organizations. And so resilience, I think, is important and is also required. Now, what are the implications for personal finances? How do you think about your own personal finances? Let me start with some simple advice. First of all, avoid unnecessary expenses while you're in school, right? So wait to buy that expensive car until you've actually got a real job, or wait to buy whatever it is you're looking to purchase until you've actually got substantial income. Pay off your student loan debt if you have some, or consumer debt if you've run up debt on credit cards. Pay that off. When you get your first real job, establish a budget, and that includes savings. Savings should be part of your budget right away. Don't put that off for the future. Start to save initially when you get your first real job. Be smart with your use of credit cards. You can get yourself in trouble fast with credit cards and high rates of interest. So if you've got a credit card and you use it for transactions, fine, but pay off the balance each month and don't carry credit card debt. Diversify your portfolio of financial assets. To the extent you've got assets, make sure your eggs are not all in the same basket. This is just the fundamental principle that you'll hear from any financial advisor, is diversify. If you want to buy mutual funds or exchange traded funds rather than individual stocks, I think that's a good idea at first. So if you've got some assets and you want to invest them and start to grow your wealth, think about mutual funds, which are managed by professional managers. They do involve fees, which reduce your rate of return. But on the other hand, you've got professional managers who know what they're doing, managing the fund. Exchange traded funds, ETFs, have the advantage of some lower fees and lesser tax implications related to capital gains. So you might think about ETFs rather than individual stocks at first. They're easy to get into. Now, for those of you that are in a context where your domestic currency may be relatively weak or maybe highly correlated with the Russian ruble or another currency that is fluctuating in value, diversify your cash holdings across several currencies, right? So you may think about the extent to which you're relying on cash as your primary financial asset. Diversify across euros, dollars, pound sterling. I saw this when I was living in Moldova in 1998, and the Russian ruble collapsed, and overnight my Moldovan friends saw the value of the Moldovan lei collapse as well. And I was fortunate enough to be paid in dollars on my project, and was not subject to the same consequences as they were. So to the extent that you have to rely on cash, make sure you're not relying on a single currency that's subject to being highly correlated with other currencies that are fluctuating wildly, like the Russian ruble is currently. If you are using electronic means to pay for your transactions, you're using Apple Pay or Samsung Pay, in a fragile economic circumstance, you may not be able to even use these electronic payment systems. So this is currently the situation in Russia, where people have to find alternative ways to pay because of the sanctions. Many of these payment systems have been cut off completely, and people have to resort to either currency or other means of transactions. So beware, these are convenient ways to pay. I know I love to pay with my watch when I go to the store and not carry credit cards or currency with me. But the ability to do that depends on the electronic payment system being available. So what about cryptocurrencies? These are the hot topic these days, and everybody wants to get into cryptocurrencies like Bitcoin. I would say beware, be cautious. First question to ask is, are these really a form of money? In monetary economics, we say that things that serve as money have to fulfill three characteristics. First of all, they need to be a store of value. Secondly, a unit of account. And thirdly, a medium of exchange. And I would caution that in all three regards, cryptocurrencies like Bitcoin do not fully satisfy this definition of money. They are potential investment vehicles, no doubt, but they're highly volatile in their value. If you look at the trend with Bitcoin in particular, you'll see it fluctuates up and down by maybe 20% over a short period of time. which is not a very good store of value. And of course, as a unit of account, a single Bitcoin these days is selling for about $40,000. And so you're likely to be thinking about units of account that are in small fractions of Bitcoin. And they don't serve well as a medium of exchange. They're not widely accepted by stores and other outlets. And bottom line, they're also dependent on access to computer networks. So if you're in a setting, especially a war zone setting like in Ukraine currently, or in Russia, you may not even have access to your Bitcoins because the computer networks are not available. So let me conclude with the advice of one of the world's best investors. If you really want to think about buying individual stocks, let me tell you about investing the Buffett way. This, of course, is named after the billionaire Warren Buffett, who just happens to be a graduate of the University of Nebraska and one of the famous Nebraskans. Here he is, he's wearing a University of Nebraska red shirt, giving advice. So I won't go through all of his points of advice, but he's well known for what's called value investing, where you buy stocks and you hold them. You buy stocks in companies that you understand, and that means you don't buy stocks in things you don't understand. He famously said for years he did not understand high-tech firms, and so he didn't invest in them. So you look for quality companies to invest in, you buy their stocks, you keep them for a substantial period of time, and you eventually sell them, of course, and you realize capital gains as a result. He advises to know the difference between price and value. Price is what you've got to pay for the share of the company today, but value is a long-term issue. If you're buying a piece of a solid company, it'll have great value in the long run. And he also advises in terms of financial news. There's a lot of noise in the financial news on a day-to-day basis, and he advises not reacting to day-to-day news stories about financial markets, but to look at the long-term trends. Focus on the right kind of news, the news that matters for the long term, not the day-to-day fluctuations. And sell at the right time, he says. So it's tempting to hold the stock until it absolutely peaks, but what often happens is people hold the stock a bit too long, and so you got to figure out when the stock is close to reaching its peak and sell at the right time before it declines. And finally, he says, invest like you're buying the entire company, and I think by that he means be serious about your investment in the company, and follow the company closely, and own the stock in the sense that you have a vested interest in the company and you follow it over time, and you pay attention to what the company is doing and how it's being run. So those are some pieces of advice from one of the most successful investors of all time, Warren Buffett. If you're interested, his company is the Berkshire Hathaway Company, and you might be interested in buying shares in Berkshire Hathaway, which he manages, or in a mutual fund that would also have some Berkshire Hathaway shares. But with that, let me stop and thank you for your attention.